Now, the Chinese New Year begins this Sunday, and it comes, of course, just as the country is in the process of reopening after scrapping most of its zero COVID restrictions. China's Lunar New Year holiday marks the world's biggest annual human migration, and it's raised fears that this year's could become a super spreader event. Nonetheless, investors are hoping the reopening will reignite growth. Last year was one of the three weakest for Chinese GDP growth since 1976. Well, joining me now is Andrew Bell. He's Chief Executive of Witan Investment Trust. Andrew, good to see you this morning. I mean, this is obviously the biggest Lunar New Year break for some years. To what extent do you think it's going to reignite growth?
Well, I think it's probably the first effect is probably going to be that it will spread COVID to the parts of the population that haven't yet caught it. Obviously, one of the unlooked for consequences of having shut down the economy and gone for the zero COVID policy over the last couple of years was that as soon as you abandon that policy, you have an enormous mushrooming of new cases. And some estimates are that something like half the population has already caught the disease. So I think that's frankly going to blow itself out over the next month or so, at obviously some human cost, but the government, I think, has made a choice that the economic costs of trying to achieve a non-achievable zero COVID outcome are much too high to be able to impose them on the population any longer.
Nonetheless, Xi Jinping really did catch everyone out with this announcement. To what extent is that potentially going to impact how investors look at China if it makes policy making a lot less predictable?
Well, I think the lack of predictability was already there, whether it was the sort of geopolitical sort of squabbling over Taiwan or the zero policy itself, or indeed the clampdown on the private sector, both the home builders and the technology companies. So I think people accept that there's a degree of unpredictability or political prioritizing is going to drive policy making. But in this particular case, I think there's a huge sense of relief, both for the benefits of any companies with exposure to China, and also probably for the well-being in the wider sense of the Chinese population, as well as for the world economy, because it's a really big deal if the world's second biggest economy, which last year slowed from 8% to something under 3%, this year seems set to probably accelerate to somewhere more like 6 or 8% once we get through the immediate impact of the super spreader event of everybody getting COVID in about 2 months, and that is an offset which is, I think, potentially bigger than the slowdown in the US economy. So it's good news for growth in the rest of the world, never mind China.
Indeed, it's also worth noting, I guess, I mean, certainly where other countries like the US and the UK have reopened, there's been an enormous cushion of enforced savings that's been put to use that's kind of insulated these economies from the worst effects of any global downturn. Do you expect the same to happen in China, or do you think they'll bank those savings?
Well, I think that there will be a degree of catch-up or revenge spending, if you like, and pent-up demand on services and goods. There's probably a less well-developed social safety net in China, so savings rates are going to stay higher, but they've always been higher in China. So I think there will be a big surge in consumer spending. Maybe because of the slowdown in the rest of the world, there won't be quite such a surge in exports as you might have expected, but I'd be surprised if Chinese growth, which has more or less been at a standstill over the last couple of quarters, doesn't bounce back very strongly by the end of the current quarter.
You've spoken about the positive impact this is going to have on global growth, but what about the possibility of it injecting another dose of inflation?
Yes, every silver lining has a cloud, and in some ways, an unlooked for benefit last year of China being in near recession was that it took the edge off some of the inflation in food and energy prices worldwide, and it's going to do the opposite this year. But we appear to have reached a stage where the extraordinary surge in inflation last year in the Western economies, hitting 40-year highs, is now on the wane. And although a pickup in China will mean that the pace of deceleration and inflation in the rest of the world will be more gradual, most likely, than it would have been, I think we've got, with interest rates probably quite close to reaching a plateau, maybe within 0.5% or 1% of reaching a plateau in, say, the US and the UK, I think the message from inflation sticking a bit higher for longer is that rates will stay higher for longer. I think the risk of having to crank up rates by another few ratchets is much lower than it would have been if China had reopened in the summer of last year.
So briefly, if you would please, Andrew, how are you playing this as a fund? What sort of opportunities are you looking at?
Well, we're positioned for a broadening of economic optimism from the US, which has held up very well, to the rest of the world in the case of Europe and the UK, and also emerging markets, because China has a very big influence on emerging markets. So we're generally quite fully invested in equities. We have an overweight call on emerging markets where they were under major pressure last year when the dollar was going up and interest rates are going up. The one area that we think is probably going to lag, and this is a hazardous thing to say after the last 5 years US outperformance, we think the US looks poor value compared to the rest of the world. So we're skewed towards cyclical recovery and towards areas away from the US. Basically, we're looking for value.
Very good. Andrew, before I let you go, I don't know whether it might be possible to have a look at you on the wide shot on camera 42 here, because I can see it on the screen here. You're wearing a tie with rabbits on. Yes, it's the year of the rabbit.
The year of the rabbit. And we're hoping to hop forward, having had the tiger by the tail last year.
Very good. No, very good. Should be in telly, Andrew. Good to see you. Thank you.
Bye, Ian.
Still to come here on Ian King Live. We're going to be taking a look at how global markets are going into the weekend. Don't go away.